downtrend across the markets was really expected, given the markets have been supported by what some have called the Fed-fueled sugar rush. The massive 6-year-long bond buying program was supposed to boost the economy, and as Karina Huber reports, it also gave stock markets an almighty shot of adrenaline that sent them to new highs.
In late 2008, the Federal Reserve announced it would be buying $600 billion worth of mortgage-backed bonds. It was the first round of quantitative easing launched at the height of the financial crisis.
It was so important because obviously at that point was crucial that we do something not only to prop the markets up, but also to promote investor confidence.
That first round of QE was followed by two more extraordinary monetary measures, one in 2010 and another in 2012 that is now finally winding down. Traders say the moves helped push down interest rates on treasuries and other assets, which caused investors to flee to riskier but higher yielding assets.
What we saw in the immediate aftermath of QE1 was we saw a rally in the U.S. equity market, but we also saw money flow to the emerging markets, both in terms of sovereign debt and other debt instruments, because their interest rates had not caught up yet to the developed world.
Here in the U.S., the S&P 500 has rallied 170% since the March low of 2009, and traders attribute most of those gains to the Fed's policies.
Had they not stepped in at that particular time, you would have seen a complete lack of confidence by investors, and I think situation could have gotten even more worse.
But Bliss says the central bank's easing primarily benefited one class of investor.
But it's really the ultra-wealthy who have made investments into capital assets that enjoy that rapid ascent in capital markets. The number one loser are retirees that don't have money in a lot of equity instruments and had most of their money in savings because they've had no return on their assets right now.
The Federal Reserve had hoped that QE would boost incomes of a larger swath of Americans, but wages have barely kept up with the rate of inflation, and growth has been sluggish. That's partially why the Fed wants to keep interest rates low for a while in the hopes that businesses will go out and get more loans to boost production, hiring, and wages. Karina Huber, CCTV, New York.